So welcome to this week's episode of Leaders on a Mission, where I'm joined by inspiring leaders driven by the impact of creating a healthy and sustainable world. And joining me on this week's episode is Cain McClary, founder and managing partner of KdT Ventures, a seed stage venture capital organization with a focus of investing at the intersection of technology and science. And I've got to know Cain pretty well over the last couple of years and always enjoyed our conversations. And Cain, thank you so much for coming on today. It's great to host you.
Thank you so much for having me, Simon. It's great to be here. Excited for the conversation.
Right. I mean, just maybe we'll start from an upbringing perspective. I'm just thinking about some of those key forces that really helped kind of shape you, really, from an influence viewpoint as you were growing up.
Yeah, for sure. And so I grew up in the southeastern United States in a fairly rural town, and my mom was an artist, and my dad, he was a stockbroker for a period of time and really saw his industry become obviated during that period of time as the world moved to online brokerages and low or no fee commissions. The role of the stockbroker as we knew it really changed and shifted. And so, while my mom continued to push the boundaries of what she could do in sort of physical mediums and artwork, my dad was really trying to find his place within the financial markets. And that was my home for a long time. And so he moved then from stock brokerage to then proprietary equity trading, to then a very small hedge fund that he had started, really trying to find where he fit in that ecosystem. And through that, Simon, I grew up with CNBC on just all the time. In the background, I like to say I have a tableside MBA. But I think that like many children do, I, for a long time wanted to be my father. And then at some point reacted against it and said, I want to be anything but my father. And so that's really what led me to science. Science to me was this intersection of creativity and objectivity all wrapped into one. I think that I had major imprinting from both my mom as well as my dad, then where my career eventually ended up. But it was an interesting place to live in the South, as folks probably know listening. It was extremely conservative. My family had been there for a long time. I like to think that I'm one of the first ones to really break out and have a growth mindset on what the world really looks like, and that unfortunately took me away from the South for undergrad to make sure that I could gain that differential perspective on the world. But that was my upbringing. I'm an only child, so I only had me growing up. And so I've kind of always been on that island, had to be an independent thinker, and really had to hustle for everything that I wanted in the world.
Great. And can you remember that moment? You talk about your dad with the stockbroker and your mum with the artistry. Do you remember when there was a one moment that really got you into the science, or there was something you saw and that was it? There was no turning back at that point.
Yeah, I mean, I really have to credit my K through 8th school. We had in 3rd or 4th grade, we have a creek that ran through our science class. And so it initially started that it was just so fun to go to class because there were like living things and we could all congregate around a creek and see the ecosystem. And it was just something different rather than sitting in a chair. But luckily, the folks that were teaching there really embedded in our minds how cool science was, and to understand where the world really got its source code from was the way that it was taught to us. So right in the time when I was learning, let's say, young kid science, it's in the mid 90s. We were just starting to think about genetic sequencing. And right by the time in 99, when I graduated, it was the arms race for sequencing the human genome. And I think that had a massive imprinting function on my mind of, wait a minute, we can read this objective code and start to understand who we are as humans, who, organisms are, how they function. And there was no turning back at that point in time once I realized that science was really turning more from an art form into engineering. And there was so much white space in between that. But a lot of it came from watching folks like Francis at the NIH, and then you have Solera at the time, and watching these early biotechs and what they were able to do with that early information. And at the same time, I was lucky enough to be fluent enough in the financial markets to whatever little summer job money I had, I was investing in like penny biotech stocks. And it was fun to read what they were working on, why they were working on it. And it fed back into the labs that I was doing at school and the undergraduate work that I was doing in the life sciences.
Really? So how old were you when you first made your first little investment into something?
I think my first investment was probably 12 or 13 years old. I remember by about 16 years old, I was putting almost all of my money in a stock called Dendrion, DNDN, which was early on the cell therapy side of things. Was also extremely interested in induced pluripotent stem cells. It was also right around the time I was in college where those were becoming more tractable. And there was one company called Advanced Cell Technologies I was invested in, another one called Genvec. And so there were a number of different biotechs that I studied and followed closely, which it was fun to me to invest. And my dad always said, investing in the stock market is like owning a brick of that company and having some ownership over some type of literal asset. And so it was fun to think about what those assets were and what the future of the assets created within the life sciences were going to be.
Great. Yeah, absolutely. And you went to med school as well, right? So I suppose most people go to med school and then, you do your 4 years and then your career normally has a trajectory. So, just tell me a little bit about that experience and what that kind of taught you and, what that,
for sure. So all during undergrad, I was constantly in the lab. I loved moving liquid around and trying to create the future, because the way that I saw it was in education, I was learning what other folks had thought about or created. And books are dynamic and education is dynamic. And so I always wanted to be a part of what the future story was going to be. And so that led to a lot of work in the lab. Now, at the end of undergrad, I had a decision to make. If I wanted to continue to do science at the highest levels, I either should go get a PhD or some type of advanced training in the life sciences, or I could do something that was more practical and gave me, I think, more optionality, which was the MD. And so I always thought that, the worst case scenario, if I go through med school and I don't end up doing science at the most elevated levels, well, then I'll just be a doctor. And like, that was tenable to me. And so ended up going to Tulane right after Hurricane Katrina. So that had just ripped through New Orleans. The med school had just come back from being away for 2 years because the city was devastated. And it was really, what convinced me to go to medical school there was it was all hands on deck. And that included all of the medical trainees in addition to the physicians that had just come back to the city. And so that provided this great place to learn hands-on medicine. Now, what I didn't realize when I went to med school was a majority of the researchers had left Tulane and the New Orleans area, because you could imagine if you have reagents that had spoiled or animal models that, weren't saved in this horrible hurricane, you're not going to come back and reinvest in that because it could just happen again. And so I found lacking the deep science side of the work there. And at this point in my career, Simon, I was really convinced that I was going to be a translational researcher. I was going to run a lab and was going to translate those discoveries into either companies or products. And that was how I wanted to live my life. But then I took a year off between my third and fourth year of medical school. I went to the National Institutes of Health. I was lucky enough to be sponsored by Howard Hughes Medical Institute, a wonderful organization that funds researchers around the United States and really around the world to do high risk, high reward science. So instead of being in the grant engine, right, where I need to basically show results that are already there to get money to, just incrementally move science forward, Howard Hughes puts you on 5, 10, infinite tenured contracts and says, just do the most cutting edge science. You shouldn't be penalized if something doesn't work. And I loved that point of view because that's the type of science I wanted to do. And so spent time at the National Cancer Institute. And actually, while I was there, that's when I made my first private investment. So was studying an area of the world known as non-coding RNAs. So the breakdown for listeners out there that aren't familiar with this is about 3%, give or take, of our genome codes for proteins, right? The things that do the work in the cells, but about 97% doesn't. And at that time, we didn't really know what that other 97% does. What's interesting is it actually has some very nuanced functions in controlling and regulating what happens within our cells. And so I was studying that, and specifically in the view of lung cancer and what these non-coding RNAs and how they're involved, what they do and how they're involved in carcinogenesis. And the genetic technologies at that point in time, so this is about 2010, were still quite expensive and cumbersome. And so I needed a technology that could profile these non-coding RNAs in high throughput and were cheap. And a buddy of mine just happened from undergrad to be starting a company in Boston at 1 Kendall Square at the time called Firefly Bioworks, and said, hey, will you test the particles? And I said, sure, it sounds like they're going to work perfectly for what I need to do. I actually went in late at night to one of the flow cytometry cores at the NIH. I ran the particles for the very first time outside of a lab. And, I didn't have express permission at the time. It's better to ask for forgiveness sometimes than permission.
Exactly.
And they worked beautifully. And I came back and said they worked. And he said, we're raising a round of financing right now. And I didn't know what that meant. And so I learned what that meant. I knew this was a problem I had. So that's other people probably had this problem. And so it seemed like a good investment at the time. I gave again what little money I had built up in the stock market over to my friend, crossed my fingers, said worst case scenario is this burns in front of my face and I have to go be a doctor and I'm set back, but this is the time to be risky and do this. And if you fast forward, that company ended up getting sold to Abcam, which is publicly traded on the UK Stock Exchange. And it was really just a wild ride that changed my life, Simon. At that point in time, I saw how fast industry moved in comparison to how fast the research that I had been trying to do over the last, call it 6 to 8 years was moving, and how impactful that is to patients and supply chains. And I said, I want to do this for the rest of my life. I want to learn about these technologies, underwrite them, and elevate the best science through my investing.
Great. No, that's wonderful. That is wonderful. And tell me, with that, as I'm thinking, clearly you love being in the lab, and it sounded like the Howard Hughes long-term. I mean, that's fantastic. I've never even come across it. It's
crazy. So just to give you an example, they have at last, and I could be wrong in my numbers, but when I was there, they had about $19 billion, their endowment, and they had only 300 researchers that they sponsored. So you can see what research to dollars type situation is lying there. And so these infinite budgets, the ability to fail, it's the same way that venture is too, in a lot of ways. And you just need to have big ideas. So.
Absolutely. So tell me, just on the venture journey, is there part of you that misses? I get being at the intersection of taking these to the market and investing in companies, but at heart, I think you love being in the lab. You love working on these technologies, right? Is there, that's a bit of a transition over for you being a venture investor, right?
It definitely is. And I think, what I'd like to believe is if you're a good investor, and I want to be a good investor, your fingerprints are left on those companies far beyond the capital that you provide. And what I mean by that is you could have strategic guidance that is not only business, but also strategic guidance in the sciences. And that's something that we as KdT try to do in scientific work plans that show a fingerprint that are our own, that came from the lab. So in a way, I'm in the lab by proxy through now multiple companies. And that fingerprint that you can have strategically on a direction that a company takes scientifically, on an adjunctive technology that you tell the founder about, that they bring in, that empowers their platform even further. You know, there are all of these different ways in which I can still be in the lab without actually pushing the liquid around, Simon, if that makes sense.
Oh, for sure. And it sounds like to the power of 10. So instead of, you know, you're just broadening out through the companies you invest in, the number of different technologies, applications,
part of that's ADD,
markets.
Right? Like part of it's just by nature. It's like, I want to do lots of different things. I want to learn lots of stuff. And I have so much respect for the people, the PIs and the postdocs and the PhDs and doctoral students that want to study one pathway or one protein for the rest of their life and want to know everything about that. I have so much respect for that. That's just not me. I want to know as much as I can about everything, and want to continue to learn, and try to keep up on the edge of science rather than staying in sort of that narrow trench, if you will.
Yeah, absolutely. And so tell me about the journey to founding KdT Ventures, because I'm sure the journey for someone like yourself would have been going to work for a big firm or you know, cutting your teeth, you know, before going out there in the world and founding your own venture capital firm.
Yeah, well, it was, I just am so lucky and blessed to be able to talk about that now, Simon. And you know, it was hard. It was really hard. So I went after medical school into residency at Stanford. I studied pathology. I really liked pathology because in my mind, they're the doctors that know everything and they're the doctor's doctor. They're just slow at getting the answers because they want to be really methodical and objective. And that was a lot of fun, but I spent a ton of time on Sand Hill Road. So where about 2/3 of the venture capital flows in the United States happen. And luckily the hospital's right on Sand Hill Road. So I spent a lot of time meeting and working with firms there to help define and shape theses around this intersection between technology, data science, compute, whatever you want to think about on that side of the stack, and the actual physical life sciences and the insights that are derived and what we can do with those. And so at that point in time, I was lucky enough to meet a number of young folks that wanted to focus on the exact same intersection, but they happened to be on the other side of the table. So outside of the hospital, actually moving capital around. I was lucky enough that they believed that I had strong opinions that were valuable to them. And that led to some very interesting discussions and projects on Sand Hill Road that led to some more investments for me. So continuing to cut my teeth in the private markets, which are very different than the public markets. And that included seed checks into companies like Zymergen, which just went public last week. And so it was, again, an intensive learning process on sort of the art of venture capital and private markets investing. I then, after residency, joined faculty at Stanford for a bit, then joined a large startup, because at that point in time, I think I had another decision point. Do I join a firm, and you probably join as an associate or senior associate and try to hustle your way, you know, over some long period of time to a partner-like position? To me, that sounded like residency all over again, and I didn't want to do that. Like I've already done that. I did it in medicine. So how can I then make myself a partner? That's the way that I looked at the world. And I thought the way that I do that is I get operational experience in a growing startup. Even if it fails, I have that experience and sort of data set to then be a valuable partner to entrepreneurs that I invest in. Because I do think that, you know, there's only so much I could learn off of podcasts, which like didn't really exist at the time. There was, you know, some decent content on YouTube, networking with folks, reading books, but what I think really sticks with you is life experiences. And I was lucky enough to work at a company that went from 50 employees to about 300 in 18 months. We opened up 2 additional office locations, I got to see what sort of hyper growth really felt like. And to me, as a seed stage investor, I'm trying to set firms up for that hyper growth stage. So I'm trying to set the footing, if you will, to allow that rapid scaling once that inflective capital and product market fit hits. And so it was really awesome to kind of see the solution prior to then going and working on the problem, which was seed stage investing. And so spent about 2.5 years there, and then had a decision to make. Do I go and join a big firm at a principal or partner or an owner level? Or do I start my own shop? And, I went through, again, an intensive decision process, spoke and was recruited by several firms. And I thought that there wasn't enough focus within these larger firms at the seed stage. What I really like are, they'll call it 1 to 5 folks that have an idea, a concept that's semi-de-risked. And I wanted to be that earliest capital partner in these companies. There was also another macro force that made me think that this was a wise business decision. And a lot of that was there are not very many technical investors at seed. There's a lot of generalists. There's a lot of firms that take kind of the spray and pray strategy where, you index or invest across broad swaths of the universe. And I thought that I had at least some technical knowledge that would allow me to underwrite early stage science companies better than the other seed investors that were out there. And I knew that if I invested in myself and it worked, the payoffs would be greater than if I had joined another firm. And that's not only monetary payoffs, but also sort of a sense of self-worth that I created something, that I was an entrepreneur in and of myself. It's probably that same creative or what my mom gave me in terms of creative mindset just shining through. I wanted to create. And what I found through that process was, creating a firm is just like creating a company, and it gives you intense empathy for what our founders go through every day, the types of scaling decisions they have to make, the types of job roles and duties that they have to fulfill, even though they have, a singular title. When you're, quote, CEO of a startup, you're doing everything. It does not mean that you're only doing CEO things. CEO things are everything. Same thing in starting a firm. I had to learn the entire stack. I had to, from tax and audit to fundraising to, saying yes or no and underwriting companies to writing investment memos. And I just think that there was no better way to learn the industry inside and out than starting my own firm.
Absolutely. Yeah, absolutely. Yeah. So it's really the empathy that you got from that, really you're in the shoes, basically. You're in the same shoes.
Exactly. Yeah. And, I think that now having gone through a couple fun fundraising processes, so much of what we do too for our companies is both empathize, but also set them up for success in fundraising. I do think it's its own skill. And I entered the industry without a network of these like mythical beings called limited partners. Like I had no idea who these people were in the world. I didn't know, where they slept. I assumed that they were like in Aspen or like, Palm Beach, or I don't know where they were, Switzerland. And I basically had to call in every favor that I had to start to try to peel the onion of what a limited partner was. And I think that strategically that helped us learn how to fundraise well, and we can pass that knowledge along to our companies.
Yeah, absolutely. So tell me, what is it? Yeah, this mythical thing. I don't know. You tell me. What did we find out?
Yeah, so there's a couple tips that we give folks. One is more practical, and I think one is softer and speaks to more of our core value set here at KdT. So the first one is you're going to hear no more than yes. However, when you hear no, you should always ask whether or not there is someone that person knows that is interested in the story you're telling or the product that you're selling. I think that generally people want to be helpful. And thus, by peeling that onion and continuing to fill the top of the funnel from a sales perspective, that's the best way that I know to do it. And I think it's genuine. And I think most folks take that when you ask genuinely and they want to help. And so, those that don't want to help, that's fine. Like, you don't need them in your life anyways, because life's too short. And like, we should find and like select an index for those people that want to help others in the world. And that leads into really a core value here at KdT, which is really kindness is like self-perpetuating in a lot of ways. The more that we lean in to loving folks and loving the science genuinely and feeling so deeply about that and being kind and doing things with no expectation of return, the more that that feeds on itself. And I just continually try to tell the folks now at KdT as we build our firm to be vulnerable. And the more vulnerable you are, I think the better it will behoove you in the world. I think so many times in business, there's tension between, not being transparent and, making sure you're paying strategic chess and all of these other things. And I've just found that if you are kind and loving in the world, that will continue to fulfill a prophecy of, of peeling that onion back, whether it's through science, whether it's through limited partner relationships, whether it's through, having good service at your back office. And so many people don't take the time to remember that or think about who they are. And there's somebody else when they're at work, and then they go home and they're probably great parents and everything else, but like, they don't take that with them every day. And that's something that we try to coach our founders on consistently.
Right. Okay, that's great, and that's very, very interesting. When you're building the firm up, how many people do you have in KdT?
We have 5 folks now.
So you have five folks, and is it, the application of that day to day, is that a challenge? How do you go around installing that kind of, because I mean, that's some value to be living your life by, right? And that just means that through the ups and the downs and all the emotional cycles of needing to follow success, you've just got this core tenet of love and connection and everything else, right? And it's beautiful. And I kind of empathize with that. How do you kind of stick with it as a core tenet, basically?
Yeah, I mean, so much of it is underlaid by being comfortable in who you are as a person. And that is harder and harder every day with the amount of technology that we have. I even think about it with my child, Simon. The world that he is going to live in is one of, we could sit here and talk about fake news, but just think like Instagram, right? Like, you're seeing everyone's best. You're not seeing the hard times that they're going through or the struggles that they have. And so much of that defines who we are, and being comfortable with who you are, I think is the most important thing that we can do. So what I try to do at the firm is encourage, an environment of transparency, an environment of enablement and support, that we're all in the same team, that, an attribution for a single deal is not going to a person, it's going to a firm, it's going to this greater whole, and you have to be bought into that greater whole. Now, each person has their own personality. We try to be adjunctive in terms of the number of different personalities that we have, because that allows us to reach more people. But that core tenet of being comfortable with yourself really enables you to be vulnerable in the world. Now, I don't want people to take this as we're not shrewd, because I do think you can be kind and shrewd at the same time. Like, we're here to maximize returns for limited partners. And there is a consequence in vulnerability that you can be taken advantage of, and that will happen sometimes over our lifetime. But as long as we continue to select for those that don't take advantage to us and that are good actors in the market, I think longitudinally, there are enough of those people in the world that we can have a very, very successful business. And so, there's constant self-reflection here at the firm, in the same way that we see startups doing their own sort of 360-degree assessments. I'm constantly assessed, as well as assessing those within the firm. And then trying to create a family, and trying to create a work hard, play hard environment where we're comfortable with each other and think of each other not only as peers, but also as each other's family members in a lot of ways.
That's great. That's really wonderful to hear. Really inspiring. And I would imagine, actually, when you're investing, and just been looking at a little bit of this myself, actually, I would have thought investing in any founder teams and making a judgment on, all right, the technology works, that's great and very exciting, this is my thesis, I like it. But then when it comes down to the people you're investing in, I would have thought making a judgment call at seed stage between 1 and 5 people in a company, are these guys are they gonna be the ones to scale this and grow this? I would have thought that would have been a kind of value that you would have really looked for when you're investing, basically, in those teams as well, to be honest.
It is. I mean, and that part of it, we can sit here and technically underwrite science all day. I think that other investors at seed are really good at underwriting teams and markets, and we're just as good as everyone else there, but our edge and differentiation is in underwriting the actual technology as well. And at the same time, we have to be sold to. And so much of getting from 0 to 100 at a startup is being able to sell your vision, to sell your plan to the board, to sell your technology to partners or customers. And so something I think that we index on in that is whether or not we're sold on this founder and the idea. And it really is that simple in a lot of ways. If we can underwrite the science, we know that it works. All I need to know now is, will this person or this team run through every single wall that's in front of them and be persistent, because they're going to hear, like we said, more no's than yeses in the world. And then secondly, can they get to a yes? Can they sell? And part of that is our own, we put up blockades, right? Because we need to be sold and we need to be convinced that you're going to be that person. And so, I think that comes naturally. I don't think that is sort of in contention with the kindness and love. We need to be sold. This is a business at the same time. And so that's I think worked really well for the types of investments that we do in the market. We also know the types of narratives that our partners like to hear, whether they're biopharmaceutical companies or large chemicals or agricultural companies. And so there is something inherent in a founder that, that I think resonates deeply with these partners when they are sincere and empathetic, but when they know that there's no roadmap, right? That's the other thing here is so many, particularly given education these days, so many folks want a detailed plan and roadmap and, a job application or whatever, they want rules, right? But there are no rules in the world. Everyone's scared and no one knows anything. And so you need to be able to function in that environment and sell. And that's something that we're constantly trying to index for in our founding teams.
Great. No, thank you for that. So tell me, just just thinking about, so you're closing, am I right? You're closing, or you have closed your second fund? Or
we closed our second fund late last year. And so we scaled from just under 20 million to this is a $50 million fund. And we plan on staying in this range of funding rather than growing significantly, because we've seen so many seed firms grow and become Series A firms. And we really think that there's a tension between assets under management and returns, because you can get fat and happy on fees and you start making poorer decisions if that's not where you grew up or what you're good at. And we really want to stay at seed because we think, and the returns are now showing, that this seems to be true, that we're really, really good at this early stage. And so we plan on staying small, despite the fact that there's a lot of capital out there and we could probably raise a lot more capital right now.
Got it. And the experience of raising your second fund compared to your first, right? I mean, I hear this the whole time when you're raising your first fund, the challenges. So just from a scale viewpoint, how much easier, fund number two?
Yeah, so it was easier. It took about half of the time of Fund 1. So Fund 1 took about a year. Fund 2 took about 6 months. Now, I think Fund 3, when we have this conversation in a couple years, is going to be even easier because we needed to do a couple strategic things in Fund 2. So we needed to add people, and that adds additional risk to the firm as a whole. And I think, sharp limited partners understand that they're hopefully buying an asset that they can re-up every additional fund. And so in a way, they're underwriting us as a team, not only as prior performance. So I brought on these 4 new people that now needed to be underwritten. So that took its own form of kind of diligence and coaching within the fundraising process. Secondly, we moved from kind of larger family offices to institutional limited partners, meaning your fund of funds and endowments and pensions and folks that we knew could grow with us if we wanted to grow. That also, though, had mandates that they want to co-invest with us in, say, larger vehicles outside of the fund. And that's something that's interesting to us. So something folks may not know is that even though AUM right now for KdT is just south of $70 million for the fund or firm itself, you can also do special purpose vehicles that increase your AUM that are sort of like their own mini funds, right, for our later stage investments. And so we wanted partners that were interested and wanted to support us in that practice. And so we institutionalized our base, and the base of limited partners underwrote a new team. So there are some dynamics in Fund 2 that look different than Fund 1 that need to be proven out here moving forward. And thus far, it looks like it is. And then I do think that, Fund 2 was raised on Fund 1's performance, which is top decile. Fund 3 will likely be judged on Fund 1's returns. So what money has that, that's all on paper right now, right? And so what is the actual distribution to paid in capital? If that tracks the way we think it's tracking, Fund 3 should be even easier than Fund 2, if that makes sense.
No, that's great. That's great. And did you talk about top decile? I think it was the terminology. Yeah. If I'm an institutional investor and I'm putting 10 million into a fund, for instance, and I want to get top performance, roughly what is the percentage range that I should look for return? Basically.
Yeah, so so if you look at, because we have to look over a 10-year period. So for 10-year funds, typically if you are doing a 3x or better return on capital, you're going to be in the top decile from the past 20 years of Cambridge Associates data. For seed funds, because we're so risky, I think that limited partners look for higher returns than that, typically in their seed bucket. In a growth bucket where you're doing $100 or $500 million limited partner commit and you just 2x that money, that's pretty darn good. But if I'm putting 10 million into a high risk, high reward bet, I'm hoping there's a chance I could get a 5, 7, 10x out of this. But no matter what, if you look at vintage year funds, even among seed, Series A, or different classes of venture funds, a 3x or better will do that, which nets out to, call it 25%, give or take, IRR. So just so folks know, currently Fund 1 for us is tracking north of 50% IRR. And so, there are going to be companies that don't make it all the way. And so thus that may artificially drop, but there's also companies that are on a sort of extreme up into the right trajectory. And so that should continue to push it forward. So the art form, right, is for us as a seed firm, concentrating capital in those winners. And that's really hard because once they're winners, everyone knows they're winners and everyone wants to put capital there. Now, we've been with that entrepreneur since day one. And so if we've done our job well, we've given ourselves the option to put in additional capital and likely a lot of additional capital in that company, if that makes sense.
Yeah, no, absolutely. Absolutely. And just finally, last question, I'm thinking about deal flow. I'm thinking about this seed stage, because as I see the market, you've got all sorts of accelerators, you've got university spin-outs, now it just seems the time, right? I mean, it's just incredible. So are you just seeing this incredible deal flow where
Yeah.
you almost have to, hold on, I can't deal with that.
No, it's a
where,
Cambrian, I mean, it's a Cambrian revolution right now in science, and the pandemic has only accelerated it. And I think that's because the whole world has seen what we're capable of doing right now with the scientific tools and platforms that we have. And there's a lot of money going into science. Now that's a competitive environment for us. We like that because it means more things are going to be funded and it's going to be better for the world. That being said, there's a lot of players now that we didn't know even 3 years ago within the scientific market. So what we have to rely on the deal flow side of things is you want to see everything and you want to see it early. And the best deals, though, typically come from two channels. One is the brand that you've created for your firm. And we are still working hard on creating that brand. And we want it to come from the investments that we've made. And we don't want it to be artificial. We don't want to pay sort of PR and marketing firms for this. We want our work to speak through the companies that we've backed and the science that we've elevated. And so that has its own trajectory right now. Then secondly, those founders that we support, particularly those that are winners, those founders know folks that are coming out of their labs. There are folks that are coming out of other areas of the world that may see that company and say, hey, this is somewhat, adjacent to what I'm trying to do. I should talk to this founder and ask them how they did this. Again, if we've done our job well and we supported that founder will naturally show us that deal before anyone else. Say, I had these amazing partners at seed, and I want to show them this technology, get their take, and they would be great partners for you too, because we know they've been great to us. And so that type of proprietary deal flow that's relationship driven is really, really important, because, if we were just a firm that was indexing or looking at like all the bio accelerators out there, like what's our edge in market? Our edge really has to come from those proprietary relationships and the brand that we build around that.
That's great. That's great. Cain, listen, I could talk to you all day. Thanks so much for demystifying a lot of stuff out there. Honestly, it's been very educational. So thanks a lot for
Simon.
coming on, sharing this with me, and wishing you all the very best as you deploy capital for for your second fund, and look forward to being in touch.
Thank you so much, Simon, for the time today. It was great to talk, and look forward to coming back soon.
Absolutely.